Hello everyone, here is Ali Talabi. This is the second lesson from the first module, financial ratios. So I mentioned that there are several ways or several techniques you can use to measure the performance of the company. We talk about trend analysis, we talk about common size analysis, and today I'm going to talk about financial ratios. So I have a kind of warning for you. There are many financial ratios you can use. And you can actually create your own financial ratio. The idea here is you can take two or more items from financial statements and you can find the ratio of those. For example, you can divide sales by net income. You can take price, you can take earnings. So you can have your own ratio as well. So I'm going to talk about some of them today, but if you Google, if you go online, if you look at different sources, you will see there are several categories, there are several ratios that you can use, and each has its own purpose of analyzing the firm. So if you want to get a full picture of the performance of the company, you have to look at all these pieces individually and then put all these pieces together to get a better picture of the performance of the company. There is no best way or best kind of ratio you can rely on. If you are an investor, you might consider using like price earnings ratio or PEG, price earnings to gross ratio. There are several of them. But given your goal, given your analysis, you might choose the appropriate one. But what we can do, we can classify financial ratios into 5 major categories. These are my kind of own way of describing the financial ratios. Again, you might find different type of categories or classification. The first one, liquidity ratios. Second, efficiency, performance or profitability ratios, financial leverage ratios, price or market ratios. So which one is more relevant to you? Again, it depends. If you are the investor, if you're looking to see how the company is going to perform, how the market is reacting to the performance of the company, you might consider price or market ratios as well as performance or profitability ratios. If you are the bank, if you are the lender, you are more concerned about the ability of the firm to pay your interest or to pay the principal back. So in this case, you will consider financial leverage ratios as the major one. So again, depending on what type of beneficiary you are, you will choose appropriate ratios. So let's talk about liquidity ratios first. These liquidity ratios are actually showing accessibility to cash or assets that can be turned into cash on short notice. So liquidity is ability of the firm to turn the asset into cash. How fast the company can turn its asset to the cash. So you can go with different ratios. For example, net working capital to total assets. We learned actually that net working capital, that's your current assets minus current liabilities. So you're taking current liabilities, you're taking out current liabilities from current assets divided by total assets. For most of these ratios, higher ratio, it means the company is more liquid. So if the net working capital to total asset is the higher, it means the company having access to those assets which can convert into cash faster, which is a good sign from the liquidity perspective. Current ratio, which is very common, is actually dividing current assets by current liabilities. Be careful when you interpret these ratios. Maybe you say higher is better, but if the current ratio, or for example, net working capital to total asset ratio is too high, it's not a good sign. It means the company is not able to use its assets in a good way. So you're piling up all these current assets, you're piling up all this cash. So what? So you want to say, oh, I have lots of money in my company or my account. It's useless. That's opportunity cost. So we learned about time value of money. So that's not good to have lots of money or lots of current assets. You want to make sure you're using that. You can look at that as a more kind of safety feature. If something happened, if I need to pay back my debt or my short-term debt, so I have these assets, which is good. But I don't want to pile up all this money and current assets with no use. Also, we have the acid test or quick ratio, very similar to current asset, but here you are more into choosing those assets which are more liquid. So in this case, you are actually ignoring the prepaid expenses. So you are ignoring the inventory. You see, you have this cash, other investment, and trade receivables or accounts receivable. You don't include inventories here. The major difference is inventories and prepaid expenses. So you don't include them. This is the meaning of quick acid test ratio. And as you expect, the quick acid test ratio should be less than current ratio. The cash ratio is you are very limited in terms of current asset. You just include the cash and cash equivalents. So you exclude investment, you exclude the accounts receivables, you just include the cash. So as you expect, the current ratio, so let me write it down here, the current ratio is greater than the quick ratio, and the quick ratio should be greater than the cash ratio. So as you are moving forward, you see the numerator is becoming smaller and smaller with the same denominator, which is current liabilities. The second type of ratios are efficiency ratios. In these ratios, you want to see how company is able to use its assets to generate income, or actually what is the impact of inventory on the cost of sales, or also known as cost of goods sold. So I'm going to refer to three major ratios here. Again, there are many of them, just I'm including three of them here. Asset turnover, if you divide the sales revenue by the total asset, you can find asset turnover. So in different sources, in different textbooks, in different references, you will see some of these definitions are different. For example, for the asset turnover, in some sources, we use average assets. We don't use the beginning of the year or assets at the beginning or asset at the end. We use the average asset. And what is the average assets? You find the beginning assets at the beginning of the year, plus assets at the end of year, and divide it by 2. So it seems a more accurate way to measure the asset turnover. Why? Because you are taking the average of your assets. So if for some reason maybe your asset at the beginning of the year it's much higher than it should be or much lower than it should be, or same for the end of year. So it's better to get the average. So if you want to be very specific, it's better to include the assets over let's say for 12 months and then add them all, divide by 12. So that's more accurate level for assets. But anyway, you can use the average or you can use asset at the beginning of the year. Inventory turnover, so it's dividing cost of goods sold or cost of sales by average inventories. Receivable turnover, similar argument, you're using the accounts receivable here and revenues. Now, in general, when you have a higher turnover, it doesn't matter it's for assets, inventory, receivable, it means you are using that type of asset or that type of inventory here in a better way. You are able to generate more sales with the same level or given level of assets. So for sure, higher turnover, that's a good indicator of efficiency. Higher ratio, it's better in your case. It means you are using your assets, you are using your inventory or accounts receivable in a better way to generate revenue. Now, some of the investors, they are very interested into performance or profitability ratios. There are several of them. For sure, these ratios are used to measure the profitability of the company. If these ratios are higher, you expect the company is generating more profit for its shareholders and investors. Gross margin is a very common one. You divide the gross profit by net sales. So higher percentage, it means you're generating more money for investors. Return on asset is another common ratio. You want to see how well a company is using its assets to generate net income. Here you have to be careful because Some of the performance or profitability ratios, they're very similar to efficiency ratios. In efficiency, whenever it comes to sales, that's my general advice for you. Whenever it comes to sales, you are dealing with efficiency ratios. Whenever it comes to net income or gross profit, you are mainly dealing with profitability ratios. So be careful which one or which classification you are referring to. Also, ROE is another important ratio, specifically for shareholders. As a shareholder, you want to have a higher ROE because with the same given shareholders' equity, you want to generate higher net income. Again, as I mentioned here, I mentioned ROA and ROE are calculated using the current year-end values for total asset and shareholders' equity. So we are considering the total asset and total shareholders' equity, and usually we include the end of year balance. The fourth class or the fourth category of financial ratios refer to financial leverage. So whenever it comes to leverage, somehow you are dealing with debt or liabilities. So in all these ratios, somehow a kind of debt or liabilities is included. So it's showing that how much financial leverage the firm is using. Again, financial leverage here, it means the fixed obligation and more specifically the debt. Why I'm saying fixed obligation? Because the argument here is when you borrow money, when you have debt, you have to pay back a fixed amount of interest, a specific amount of interest. That's why it's fixed. And you know, the debt holders or those you are borrowing the money from, they have priority over other investors, including shareholders, in terms of getting back their money. So the leverage ratios are very important. The credit rating agencies, the lenders, they consider these ratios seriously, because if these ratios are not in good condition, it means the chance of default risk is high. What is default risk? It means you are not able to pay back the money you borrowed. That's the default risk. So long-term debt ratio, so it's a long-term, mainly long-term debt divided by total asset. Here you have to be careful because as you see, I'm using actually a long expression, long-term debt, value of leases, preferred equity, common equity. In other words, that's your assets. Just assets. Just there is one major difference. Usually we don't include the current liabilities in the debt ratio. But I've seen in some sources just they divide the long-term debt by assets, which is technically correct, approximately correct. So it's not a big deal. So you can use total asset instead of all these items: debt, lease, preferred equity, common equity. Same for the long-term debt to equity ratio. You see, I'm saying here preferred equity, common equity, I mean total shareholders equity. So you can include the total shareholders equity here. So what does it mean? So if you have higher ratios for both, if we have the long-term debt ratio is higher, long-term debt to equity ratio is higher, it means you have higher debt in your capital structure. We learned the first module when I talk about how firms financially operate. So please refer to that video. We talk about that. We mentioned the capital structure. It means what is the combination of debt and shareholders' equity. If you have lots of debt in your capital structure, it means the leverage is high, the financial leverage is high, which means the financial risk is high. So when you look at these ratios, you have to be careful that high debt ratios are indicator of high financial leverage and risk. There are some other financial leverage ratios times interest earned. If you divide operating income, EBIT's earnings before interest and tax, if you divide operating income by interest expense, you can have times interest earned. So it's showing how much profit, how much operating profit is available to pay off your interest. So if it's higher, that's a good indicator. It means that you have enough money, enough profit to pay off your interest expense. So that's a good sign. Cash coverage ratio is very similar to times interest earned. The only difference here is you're adding back depreciation and amortization. Maybe you say, Ali, why? Because the argument here is depreciation and amortization are not actual cash outflow. So you can add them back into your available profit. So you're adding back to operating profit to have a better understanding of your coverage to pay off your debt. EBITDA, earnings before interest and tax, depreciation, amortization, it's actually your EBIT or operating income when you're adding back your depreciation and amortization. So if you add back depreciation, amortization to EBIT, that's the same as. So that's why I tell my students that it's actually your EBIT plus depreciation plus amortization. What's the difference between depreciation and amortization? You're right. Usually we use depreciation for tangible assets, amortization for intangible assets. Price ratios, also called market ratios. So there's many of them. Price to book value, price to cash flow, price to earnings. The very common one, which is very common in the financial markets, price to earnings ratio. It's showing how pricey, how expensive is the stock. If you go now to, for example, Yahoo Finance, and you look up for some IT companies, you will see some of them, they have a huge price earnings ratio. Why? Because they have a little EPS, earnings per share, but their stock price is very high. Why? Because the market expect that in the future they are going to grow fast. So higher price earnings ratio, it means the potentiality to grow is higher. But if you look at some auto manufacturing companies, for example, or if you look at some banks, you will see that price earnings ratio maybe 6, 7, 5, not that high. It means the growth opportunity is much lower, and they're going to grow much slower. That's why I'm saying this is kind of more relevant to, these are more relevant to markets and financial markets. So if you're interested, I would say go and look at some companies online, Yahoo Finance, for example, go and look at Google, Facebook, Tesla, and compare that to other companies which are in other industries like auto manufacturing companies or banks. So you can go and look at, for example, TD Bank, or you can look at the Royal Bank and see how actually the price earnings ratio is comparable. Now, we talk about 5 major financial ratios. You can advance your understanding of ratios by looking at something we call DuPont system or DuPont analysis. The DuPont system is actually combining some of these ratios to give you a better picture of the company's performance. In the 2-part model, you are actually just including the asset turnover and operating profit margin. So the asset turnover, as we learned, that is just sales divided by total assets. The operating profit margin is NOPAT. What is NOPAT? Is net operating profit after tax divided by sales. Maybe you say, Ali, that's ridiculous. You can get rid of sales and you will have NOPAT divided by total assets, which is your ROA or return on assets. Why we are breaking down into 2 ratios? Remember, our goal here is to analyze the performance of the company. If I give you the ROA, say, Ali, I say, you know what? This is the ROA of the company. Like, let's say the ROA of the company is 20% or 0.2. So, which is good. But the level of analysis is limited just to ROA. But you want to see why the ROA of the company, for example, is too low. You have to go and look at the asset turnover and the profit margin. Maybe the reason is the asset turnover is not high enough, or the profit margin is not high enough. So there might be 2 reasons that the ROA is not high. So that's why it's better to look at DuPont system. It's better to look at these ratios instead of just looking at ROA to judge regarding the performance of the company. You can even further advance your analysis from the regarding the performance of the company, and you can look at the 4-part DuPont system. So in the 4-part DuPont system, actually you're looking at leverage, asset turnover, profit margin, and debt burden ratio, as you see here. So here it provides you a deeper understanding of the performance of the company. The first portion is showing the leverage of the company, asset to equity. So higher asset equity ratio, it means the company is using more debt or liability in capital structure. So the company is more leveraged. You are right. The sales asset, we learned that that's asset turnover. The no path to sell is showing the profit margin. And finally, the debt burden is showing actually what is the role of debt in generating net income. So what's the difference between net income and no path? You're right. In no path or net operating profit after tax, you haven't subtracted the interest yet. So the interest is not there. Net income is after deducting the interest. In other words, you want to see how much interest actually you have in your income statement and what is the impact of that interest on your net income. So net income to NOPAT is measuring the impact of interest on your net income. Now, when you look at this, when you combine them, and for sure you can see the assets are canceling out, sales are canceling out, NOPAT are canceling out, and at the end you will have net income and equity, which we learned that's ROE. So as an investor, specifically as a stock investor, you are more interested to look at the ROE, return on equity, see how much net income is generated for me. So given the shareholders' equity, how much net income is generated? So you can look at all these four components, and based on that, you will see the impact on return on equity of the company. Be careful. I received this question many times. Leverage is good or bad? It's good to have a debt, or it's bad to have debt? The answer is yes. I know the short answer is it depends. If the company is able to generate profit, for example, the profit margin is high, for sure, leverage is good because you are borrowing the money, you are generating even further money, which is good for investors, it's good for shareholders. However, if you're not able to generate enough money to pay back your interest and debt, you will be in trouble. So it works like a two-edged sword, so which is not good. So let me wrap up this lesson. Remember that just looking at these three different analyses, trend analysis, common size analysis, and financial ratios analysis, it's not good enough. It's always better to have a benchmark. This benchmark might be industry or a similar company you can compare with. So for example, as I mentioned, auto manufacturing company, maybe the norm price-earnings ratio is 5. So if you are in the IT sector and your price-earnings ratio is 20, you cannot compare that 20 with 5. You should find a similar comparable benchmark to see whether you are performing better or worse than that benchmark. So you can use the industry average or industry ratios. You can find a similar other company. So, and also, as I mentioned earlier, you can combine some of these methods. For example, you can combine common size or financial ratio analysis with trend analysis to get a better picture of the performance of the company. Thank you very much. Here's Ali Talibi. I will wrap up this lesson, actually this module, with the next session. We'll talk about some review questions and common mistakes. Have a wonderful day. Talk to you soon.